And we're back. Let's continue our discussion on money, the Federal Reserve Bank, and financial institution. What this chart just shows is the control method by the Federal Reserve. So, in essence, we just talked about that when the Federal Reserve require banks to keep a larger sum of money in the bank, reducing the money available to be given to commercial banks, that slows the economy. But when that requirement is reduced, meaning that banks are allowed out more money, that can speed up the economy. We also talk about a open market operation. When the Fed sells bonds, then money flows from the economy to the Fed, meaning that people are actually buying bonds from the Fed, not the Fed, from the Fed. That slows the economy. But when the Fed are buying bonds, which can be bought from the government or they can buy them from other commercial organizations, then money is flowing to the economy and the economy speeds up. Now, the discount rate, that is the interest rate at which the federal government loans money to the commercial banks. So, yes, banks have to pay interest to the Federal Reserve. When those rates are increasing, the banks are going to borrow less money, which slows up the economy. So, as you all know right now, interest rates currently are extremely high, which means that the Federal Reserve is charging the bank higher rates. The bank then charges the consumers higher interest rate, which slows down the economy. But when the rates are lower, then banks borrow more money from the Fed, not from the Fed, from the Fed. What's wrong with me today? Banks borrow more money from the Fed. There's more money to lend out, and that speeds up the economy. So I'll give you a quick example of that. The housing market. A few years back, interest rates were as low as 2%. The housing market was booming. People couldn't buy enough property. But now interest rates are around 8 or 9% because the rates are so high that has slowed down the housing market. Okay? So as I mentioned, open market operation is the buying and selling of U.S. government bonds by the Federal Reserve Bank with the goal of regulating the money supply. So the Feds, again, they're the ones who change the interest. Well, we'll talk about rates in a minute, but they understand that when they buy and sell U.S. government bonds, that's going to impact and allow them to regulate the money supply. The discount rates, again, are also set by the Fed. I keep saying Fred. The discount rates are also set by the Fed. You may have heard of the prime rate. Again, the prime rate is the rate that the Fed charges commercial banks when they loan them money. Okay, so the Fed controls the rates, which is the rate institutions charge when they lend money to other institutions, and in turn, it impacts the rates that we are charged as consumers. So the interest rates that you're paying on your house, on your car, student loans, is pretty much all controlled by the Federal Reserve System. Now, why do we have a Federal Reserve System? I'm glad you asked that question. Well, there was a cash shortage problem back in 1907. There wasn't enough currency being printed in order to stimulate the economy, which led to the creation of the Federal Reserve System. And it's their job to monitor or oversee the monetary supply, if you will. So, under the Federal Reserve Act of 1913, all federally chartered banks had to join the Federal Reserve. So if you want money as a bank, you have to be part of the Federal Reserve System. Back in 1929, we had the stock market crash, which led to the failure of a lot of banks in the early 1930s. At that point, Congress passed legislation between 1933, 1935, that led to the strengthening of the banking system, including the establishment of what we call federal deposit insurance. So now, when you put your money in the bank, your money is insured with federal deposit insurance. And we'll discuss that in a little bit more detail in a few. This is showing the biggest bank in the United States holding in trillions of dollars. So JP Morgan Chase is one of the biggest banks, followed by Bank of America, Citigroup, and Wells Fargo. So these are the biggest banks that we have in the United States of America. The U.S. banking system consists of commercial banks, savings and loan associations, credit unions, and non-banks. So let's take a look in more detail at the different components of the U.S. banking system. So the commercial bank would be your Bank of America, Wells Fargo, JP Morgan, etc. These are profit-seeking organizations that receive deposits from individuals and corporations in the form of checking and savings account and use those funds to make loans. So when you put your money in a checking and or savings account, then the bank uses your funds in order to loan money out to individuals and also to other business organizations. A commercial bank has two type of customers: depositors and borrowers. And yes, you might be both. You may have a savings account with a bank, commercial bank, but you may also have a commercial loan, such as a mortgage, with that bank as well. Okay. What are Americans looking for in banking? Well, most Americans now, they're looking for a bank that has mobile banking, meaning that I want to be able to use my phone, if you will, for my banking needs. We're looking for low fees, safety, convenient locations, interest rates, and low balance requirement, because some banks require you to keep a certain amount of money in your account to avoid paying some fees. As a matter of fact, I need to call my bank because I saw a charge on my statement. I need to know why they charged me that money. Thanks for reminding me of that. Okay. Now, with the service provided by commercial banks, demand deposit. That's a checking account. It's known as a demand deposit, where money can be withdrawn anytime on demand from the depositor. So your checking account is known as a demand deposit. Your savings account is called a time deposit, where a bank can require prior notice before the owner withdraws money. So sometimes with a savings account, depending upon the terms, you may have to give the bank a notice, and those funds may become available in, say, 1 to 2 days. A CD, which is a certificate of deposit, is a savings account that earns interest to be delivered on we call the certificate maturity date. So a CD may mature, say, in 12 months. During that 12-month time period, the amount you put in are going to earn interest, and you can withdraw the amount you put in plus interest on the date the CD matures. Now, be cautious with CDs. If you take your money out before the maturity date, you will be charged a early withdrawal penalty. Okay? Next up, we have the Savings and Loans Associations, which are, well, go back to commercial banks. Commercial banks also give out loans. Typically, the loans would be in form of personal loans, mortgages, or lines of credit. But the loan rates, if you will depend upon the credit worthiness of the person trying to borrow the money. So your credit will impact whether or not you can receive a loan from the bank and the interest rate on that loan. Okay. Next, you have the Savings and Loan Association, the S&Ls. These institutions accept both savings and checking deposits, and provide home mortgage loans. They're often called thrift institutions because their original purpose was to promote customer thrift and home ownership. So the S and Ls were created in order to provide people seeking home ownership. Credit unions are nonprofit, member-owned financial cooperatives that offer the same services as your commercial bank. Difference is they're nonprofit, commercial banks are for-profit. So often credit unions may give the members a better interest rate than a commercial bank. And that's because those members, if you will, are owners of that credit union. And their intent is not so much to make a profit with the credit union, it's to provide services to the members of their community. And also, as a nonprofit credit union, enjoy an exemption from federal income taxes. So, credit unions do not have to pay federal income taxes. Let's look at these other institutions that we call non-banks. These are organizations that accept no deposits but offer many other services provided by regular banks. For example, your life insurance companies. They offer some of the same services as banks, but they do not accept deposits. Pension funds. Pension funds are the amount of money put aside by corporations, nonprofit, or unions to cover part of the financial needs of members when they retire. So most companies have a pension fund for their employees where the employee and the employer may put so much money into the pension fund so that when you retire, those funds are going to be available. Brokerage firm, companies that deal with stocks, are also considered to be non-banking systems. That you have your commercial, finance companies, and corporate financial services. These are all examples of what we call non-banking institutions. Okay. Now, back in 2008, there was a banking crash. So, if those who are not familiar with what took place in 2008, there was a banking crash that really impacted the housing market. There were millions of people who were not able to pay the loans on their mortgages due to some scrupulous transactions where people were borrowing more money than they should have. Houses were being appraised at values higher than what they really were valued at. There were some fraudulent transactions taking place, and a lot of people found the value of their homes decrease significantly. Okay? So the question says, who was responsible for the banking crisis of 2008? Some believe the federal kept the cost of borrowing too low. So the interest rates were lower back in 2008, which means there were more money to lend out and there were more people buying houses. Some believe that Congress pressured banks to make risky loans. So because these banks had all this money, they loan money to those who probably didn't really qualify for the loan, and the banks were taking a risk, and that risk backfired on them. Okay? So banks divide portfolios of mortgages up and sold their mortgage-backed securities. So pretty much what happened was that because with a foreclosure, the bank now takes possession of that property, which is your house, but the banks are not landlord, so they were forced to sell these properties to investors at a reduced price. So some believe that the Fed and Security Exchange Commission failed to issue sufficient warrants. So there were implications that a crisis was coming, and some feel that the Feds did not warn the U.S. economy about the pending crisis. Okay, so we're almost done. So stay tuned for the exciting conclusion of our chapter 20 lecture. Bye bye.